basically made up of, you could say it is, in a sense, you've got years to maturity or time to maturity. This could be periods as little as months, it could be days, could be years. But if you use years, okay, and you looked at, let's say, a Treasury yield curve, okay, we could also be looking very much at, if these were short-term Treasuries, at the term structure of interest rates, because short-term Treasuries are very close to what we call the spot rate, and that's what makes up the term structure. And all it is looking at different short-term to long-term bonds of different maturities, short-term and long-term, and how the rates vary, the yield varies. So that's why they call it yield to maturity. Well, in a sense, not really yield to maturity. I wouldn't go that far. So we're going to go through, there's a couple of theories about explaining the term structure. Real nominal rate of interest. That would be discussing the relationship of 1 plus R, big R, equals 1 plus little r plus 1 plus h, which is Irving Fisher's theory. And this talks about inflation, okay, and the difference between real and nominal rates. And when you're looking at the nominal rate, in this case, this would be inflation. And I'm going to hold off, but we'll come back to that. There are some risks involved in, just as inflation right here, there are some risks involved in the bond market. So again, looking back at this, before I go into the risks of within the market, this one right here, this is the big R is considered the real rate. This is considered the nominal rate, okay? And usually we use one to solve for the other, because what this does is, whether you're looking at interest rates in this case, or whether you're looking at cash flows, the real amount is usually less than the nominal. Usually when I make videos, I want to say that I did lose my notes on this particular topic, my lecture notes. So we're making do here, we're winging it. The problem says, for number 5, in November 2017, treasuries of 4.75% of 2041, the year 2041, offered a semi-annually semi-annually compounded yield to maturity. That's the interest rate, going market interest rate of 2.6%. So that's what we would discount it at, recognizing the coupons are paid semi-annually to calculate the bond's price. I believe this is a little off compared to the solutions in the book. I think the solution used, if I want to say, well, let me look at it. I believe it was 27 in the solutions. Anyway, let's set it right. Let's set the record straight. Okay, so I'm hoping you guys can see this. Let's go into this. So what they're saying is, we have a, where did the problem go? Number 5, in November 2017, treasuries paying a coupon of 4.75%, and with a maturity in 2041, the year, offers a semi-annually compounded YTM of 2.6%. So there's our key factors there in this bond. Recognizing that the coupon is paid semi-annually, calculate the bond price. We didn't do semi-annually, but it in class, but it's not hard to figure out. All right, so just a heads up here. And here we go. Even though I've worked them already, I'm going to go through the calculator, and we'll kind of make a little timeline for it. So in this case, we have, again, I don't know why I keep looking back at this problem, in November 2017, So that's presently where we're at. And this is a semi-annual bond. Okay, so let me use my little red pen. I'm hoping you guys can see this. Let me zoom out a little bit, or actually, what would be the default here? Right there. Okay, so if we looked at, we've got 4 3/4 right there, which translate to 4.75 coupon. This is a Treasury bond. Does it say that? Let's see. Yeah, Treasury, 4 3/4. And we're presently at November, and this is a November 2017 issued. It matures in the year 2041. It has a yield to maturity of 2.6%, and it pays those coupons semi-annually. Okay, so what would this bond look like if, let's say, we don't know actually when it was issued. Maybe it did say it was issued November 2017. Not necessarily. But anyway, with that, the one thing that's missing here is our timeline. So what I would do is take this, and I would take the years to maturity. We need years, right? So I'm going to get, let's do this right here. I'm going to get our number of years, which is 2041. That's 2017. Gives me 24, right? Now, if this is a semi-annual bond, let me reframe how we do this. This will be, the payment will be divided by 2, okay? Each rate will be divided by 2. Okay, guess what happens to the n? Okay, that is times 2. All right, and this is times 2. That's divided by 2. So your interest rate is divided by 2, or yield to maturity, and your periods are times 2. That will give you the appropriate setup for a semi-annual bond. Okay, much easier to do in the calculator. So how would we do it in the calculator? Well, how many years do we have? I'm going off the sheet that I did. So we have n times 2, which is actually, we've got 2041 minus 2017, 24, times 2, that's 48 periods, right? So knowing that, I can actually set this up. Let's see. Our interest rate was, or yield to maturity, was 2.6, and that is divided by 2, right? Knowing the coupon payment, what's the coupon payment? Would be 1,000 times 0.0475. And that should give us about, I worked it out here, and we've got this right here, and that gives us about, if I didn't divide it by 2, our coupon payment would be equal to $47.5 annually, divided by 2 gives us $23.75, okay, per semi-annual period, okay? So when we're working this out, and I actually am looking at this, I can just draw this in. Here's N, all right, for the calculator. Here is yield to maturity, all right, and there's our I over Y, and we've got 2.6%. So you just enter that straight in the calculator, divide by 2, you get 1.3. That's what I'm going to put in the calculator. Our payment, they tell us that it's a 4 3/4, which translates to 0.0475 times $1,000, even though that doesn't look like $1,000. That is a comma there. And that amounts to 47.5 divided by 2, since it's semi-annual, we get 23.75. Present value, we don't know. That's what we're solving for, which will give us what the bond should be selling for. And hoping you can see this. And I believe it is adjustable. And future value is going to be the amount at maturity, right? So I solved by formula first, but the very first thing that I did not do, and shame on me for not doing that, okay, is, and I'll get rid of this, is to set up a timeline. So, and that's what I asked you folks to do on the test. 0 to 48 periods here. And again, this would be about a 24-year bond or left to maturity. And the amount of coupon per semi-annual, okay, this would be period 47. This would be period 1, period 2. In this case, we don't have anything up front, but we do have a future value, right? It pays out $1,000 upon maturity and pays semi-annual interest, okay? So in this case, and I'm going to keep this on the annual level that's paid at the very end, okay? Now, when we look at this, and don't be confused by that. That's just to give us an idea of what the full maturity amount is. When I'm looking at this, notice how I calculated it, okay? Now, I didn't set it up exactly in the proper form. What do you notice? Now, if I did it like this, which is one way of doing it, okay, I've already kind of did the division and everything up there. The way I would do it is to put everything in semi-annual. So I'm just going to write semi-annual. Okay. And this would give me a payment of $23.75. Can you guys see that? $23.75 per period. $23.75. Okay. So we got an annuity of $23.75 over 48 periods, plus the payout at the end on maturity. Okay. And so remember, these are already divided by 2, each one of these, because I did that at the very start. I took 26.2 divided by 2. Even the payment the coupon payment was divided by 2. That's just to do it, if you're doing it by formula. And I arrived at 1,382. I have no idea if that's correct or not. I'll look in a minute, or near correct. But when you set up your formula, or excuse me, when you set up your timeline, you definitely want to have the maturity amount there, okay? These are semi-annual up to 48. And the only thing that we're missing is yield to maturity equals, all right, in this case, 2.6 divided by 2 would be, on a semi-annual basis, 1.3%, okay? And our coupon rate, how we got those, the 23.75, I just took 1,000 times 0.07, or excuse me, times 0.0475. All right, so let me check out that solution. So let's do this all together. You ready? All right. So let's do n equals 48. Okay, should I clear it? Yes. N equals 48. And you can do this in any order. 1.3 is our semi-annual discount rate. And I'm going to enter that right there. Payment, remember, is divided by 2. I had 47.5 divided by 2, 23.75. $23.75. And that's my payment. And I've got to set the 4 spots. So again, there's could be some rounding issues. I have a $1,000, okay? And normally I would take, where's it at? I'm going to leave the 1,000 at the 1,000, okay? But let's see what we get. We could also divide it by 2. Actually, what am I saying? We don't divide that by 2. Okay, so let's enter the 1,000 for the future value. And we get a compute present value, 1382.075. And this is the one I did by hand. Notice I put approximately 1,382. Is it selling at a discount or premium on this semi-annual bond? It is actually selling at a premium, right? It's selling above $1,000. What it sold for originally or was issued for was at par at $1,000. So now I would imagine that the yield to maturity is actually fallen down below. And if we look at the relationship between the yield to maturity and the coupon rate, let's see what's going on here. So yield to maturity is semi-annual is 1.3. Okay. Our coupon rate is 0.0475. Okay, 0.0475 or 4.75%. Okay. And so if I've got a coupon which is bigger than yield to maturity, and in this case, I did take the 0.0475, all right, and we use that to calculate the coupon, all right, but we can also look at it in terms of, let me just compare annual to annual here real quick. This would be 4.75 is greater than 2.6 on an annual basis, the yield to maturity. Okay, that tells me, that relationship tells me that I'm going to get a premium bond, which a bond that's selling for greater than $1,000. Okay, and to save time, a little time here, let's go back to the relationship before we go into the interest rate risk. And let's take a look at these relations, okay? One thing I did not do was calculate the current yield, okay? Current yield is just taking, okay, in this case, we would take, let's see, what is that? You're going to take the annual coupon, which is 47.5, right? 26, what is it? 23.75 times 2, 47.5, divided by its present value, or current price, what it's supposed to be selling at, 1,382. And this should give you, you're basically marking it to the market to get an idea of how much it should sell for. This should give you about, did I just do that? 47.5 divided by 1,382. Gives me about 3.4% on, and that would be an annual basis. Okay, so notice that we've got the coupon, which is greater than the current yield, which is greater than the yield to maturity. In this case, you're going to have a premium bond. Okay, a bond selling for more than 1,000 or whatever the maturity value or par value is. In this case, my annual rate is 3.44. Okay, that's for my current yield. My yield to maturity on an annual basis is 2.6. I know that's kind of messy. And the coupon rate was 4 3/4 or 4.75. All right, so it's good to understand these relationships. This is in that guest handout. It's titled Chapter 6, and it is for the undergrads, but it's it has some very good parts that are very relevant to what we're doing and understanding in terms of management. So if you turn to, I think that's slide 11, you're going to see that, and let me zoom in a little bit here, that I also have the calculation of the current yield, which is just the annual coupon divided by the current price. And notice it says the concept of current yield is closely related to other bonds concepts, including yield to maturity and coupon. When a bond sells at a discount, yield to maturity is the opposite. It's greater than the current yield, and then greater also than the coupon yield. You could take current yield out. Just do YTM is greater than coupon. That way you know it's selling for less than 1,000. In this case, we've got a bond that sells where the coupon yield is greater, 4.75, and the current yield was like, what was it, 3.4, and our yield to maturity was about 2.6. So we know it sells for a premium, selling for about $1,382. Okay, and if it's at par, okay, everything's equal. YTM equals current yield equals coupon. All right, so coupon yield. All right, with that said, ladies and gentlemen, let's go in to the next part. Sometimes it's a little different explaining some of these concepts. You know, if you look at the time that it takes to recover at least the present value of the bond in terms of its cash flows, when you discount the cash flows, how long does that take? Okay, how many periods? If you were to look at that, that would be what we call duration, or Macaulay duration. Okay, and if you looked at that versus the bond to maturity, right, which is basically holding on to the bond until it matures. All right. So in terms of duration, you're really looking at an amount of time, and I'm going to go through that calculation right now. We actually touch on this in our PowerPoint, so I wanted to go through this. The way it relates is Macaulay duration does give you that weighted average of life of the cash flow, so to speak, or how long it takes to recover that present value of the bond. If you look at modified duration, which is just taking that time period of what it gives you divided by 1 plus yield to maturity, that's kind of the formula. It's not the true formula, but it's close enough. If it was semi-annual, you would divide by M, or 2. Okay, so in this case, this gives you the price sensitivity. So there's different types of durations. This one is really all about price sensitivity in terms of interest rate risk. When the interest rate moves, what does it do to the price of the bond? How sensitive is that price, okay, to interest rate movement? The shorter term, okay, and we're going to go through that in a minute. So let me come back to that. All right, so let's just real quickly go through the PowerPoint. Then I'm going back, finishing out the homework. You guys, so I went through a brief introduction at the start. I just finished chapter 5. Problem number 5. Remember that if I thought, and let me just kind of talk about this on problem number 5, I figured out the present value of that semi-annual Treasury bond. In this case, if I thought it was, let's say, the Treasury was risky, I might ask for a higher coupon rate or a higher rate. So let's kind of go through and see how things adjust here. I'm going to be switching between this and the guest lecture handout. Of course, a little easier to do in person. Thank you guys for being patient. We've gone through the different parts of the bond. Okay. And now let's go into in terms of duration. Okay. So we're going to hit on duration. Then we'll hit the term structure. We'll hit the risks within the bond market. So if I think there's an interest rate risk, or if I consider any type of other risk, I'm probably going to tack that on to the price and especially the going rate on the bond. Okay. So when we look at this, do bond prices vary with interest rates? Yes, they do. Okay. Are they perfectly, is there a perfect linear relationship? No, there isn't. It's usually convex. So in other words, if the interest rate goes up by 1%, does it change the bond price by so much? Exactly 1%. In this case, maybe on shorter term, but not in general, no. Okay. I'm going to go through some of the different risks within the bond as we talk about that. But before I do, let me go through this real quick. So what are we talking about? I went through and numbered each one of these. And let me look at this real quick. Give me 1 second. What in the world was I doing here? It's when we're looking at, before I go into duration, when we're looking at the rate of return on our investment, okay, it's really important to also look at, if we're, and we do this with stocks as well, is to look at the coupon income, okay? So if we saw something like this, this is a very, very good example. This would be your coupon amount. It's pretty hot in my office, so forgive me. Coupon rate or amount. Let me write this, amount. Okay, or coupon. Okay, plus the future price less the old price over the old price. Okay, that's going to give you your rate of return on investing in the bond. Okay, so when you look at this, and again, this is basically what we're talking about, and this holds true for not only bonds but also for equity, and in terms of stocks, this could be dividend income. We look at our rate of return, we're also including in, just like we include dividend income plus any capital gain or price change in stocks, okay, over the original price. We do this with bonds. We include coupon income plus any price change over the original amount. And so if you look at this, that's what they're doing right here. And I labeled this as slide number 14. I noticed the slide numbers were not on there. A bond increases, and this is for chapter 3. A bond increases in price from $963.80 to $1380.50, which is quite a bit, and pays a coupon of $21,875 during that same period. What's the rate of return? Well, it's pretty easy to find out. It'd be large, I can tell you that. If we looked at this part, that would be what we call capital gains, okay, or loss, if it was a loss. If we looked at this part, this would be the coupon yield, and that is a $21, almost $22 coupon, okay? So just a heads up on that. Now, as we get into duration, right? And I was just talking about duration. We're going to do a little exercise. I'm not going to go off in tangents, or try not to at least. The one thing I am going to show you is we will do a short, real quick problem. Macaulay Duration, right? And we'll only do it if we have time. It's basically figuring out the time it takes to recover the present value of those cash flows. So when we look at that, and it also is an indicator in terms of price sensitivity, especially when you combine it into what they call a modified duration. And that is just duration over 1 plus yield to maturity, okay? Some people like to say it's the weighted average life of the cash flows. And so this nice looking huge formula, okay, will give us some sort of a time period. And Obviously, it's a little tough to do it like that. So let's go ahead and go through one of the homework problems, okay? I can tell you some of the things that will affect it. And let me just go through here real quick. If you look at the duration of a coupon, zero coupon bond, okay, the duration actually equals time to maturity. And I'll come back to this. These are just little nuggets about maturity or duration which come into play in problem number 3. All right, so how do we calculate duration? I think that's number 13. Let's check it out. So again, before I go there, there's a couple of things that, if you think about it, they make pretty common sense, and I wrote them down. Holding maturity constant, if your coupon rate goes up, okay, the bond duration is going to go down. All right, no, actually, this is better that we go through this after. Okay, so let me go through that real quick. So let's find number 13. Whoa, look at what we have here. And then I will look at the others. So this is security A. All right. Security A. We got it. All right, let's do this. Time for coffee. Go through this, number 13. Security A. All right, so let's look at the problem. The problem for number 13 says duration. Calculate the duration and volatilities. Let me see if I can zoom this in. Calculate duration and volatilities of securities A, B, and C. Their cash flows are shown below. The interest rate or yield to maturity is 8%. That would be the discount rate. Okay. And so notice that we're receiving 40, 40, and 40, okay, which is pretty spread out. Notice that on security B, got 20, 20, and then 120. When you have large cash flows towards the end, tends to make a bond, in this case, even though they call it a security, less longer, make it have a longer duration. So if you had 10, 10, and 110, that would indeed have a longer duration. The closer your cash flows and the higher they are, closer to the beginning, the shorter your duration is going to be. And again, that duration, we'll see how we calculate it. So we're going to calculate this 40, 40, and 40 for 3 periods using an 8%. And I'm just going to take I'm going to show you how I do it, how I set it up. Okay. And it was set up horizontally. So the way we do that, and there are duration calculators, okay? But just a heads up, the way I did it was I set them up years 1, 2, and 3. Again, some people call this Macaulay duration after Frederick Macaulay. When we look at this, and before we go into real and nominal interest rates or the bond market risk, or term structure for that matter, let's finish this out. Hold on one sec. Okay, so let's finish this out. So basically the way you set it up is we've got $40 coupon payments on this security or bond A. Okay, our discount rate is 8%. So we've got the $40 right there. 1, 2, and 3. Okay, 3 years. 2, 1. All right. So the very first thing you want to do is you want to take the present value of these cash flows. So that would be step 1 is right here. Using the 8% yield to maturity or yield discount rate, present value of the cash flow. And so for this one, this would be, let's see if I can draw this in here. Let me use a blue pen to make it a little, maybe. Let's see if I have a different pen here. Would be 40 divided by 1 plus 0.08 to the 1. right? And so on and so forth. Then you would have 40 divided by 1.08 to the 2, and then 40 divided by 1.08 to the 3. All right. And when we get this, we've got $37.04. 34.29 is in the second year. And I believe that is, hold on one second, let me redo that one. That would be this last one right here is $40 divided by, you guys see what I'm writing? Okay. No, you can't? Okay, hold on one second. Let me see if I can open this up here a little bit. Okay, there we go. So in this case, we've got 1.08 to the third, and that will give us our present value at times 3. What am I saying? At times 0 for 3 years out. And if we were to do this, you could do it just by hand. 40 divided, 1.08 to the third gives us 1.25, so I'm going to store that, 1.25, and let's do 40 divided by, recall 1, that's going to give us 31.75, okay? So I left out the 1 right there, that's 31.75. So when you take the present value of each cash flow, it adds up to a total of 103.08, okay, which should give you the present value of the bond. Now, in terms of how that relates to time, the next thing you want to do is you want to take the proportion of, let's say in this case, we're going to take 37 point, I believe that is, let's see, what is that, 37.64 or 04? Let me see. That would be 40 divided by 1.08 is 37.03. Shame on me. Okay. So it's actually 0.4 now that I look at it. Okay, so when we do this, now we're going to take this and divide each one, see the 37.04, by the total present value of 103.08. And that's going to give us our proportion, okay, as it's related. And then we're going to take that times the number of periods. So this would be 37.04 divided by 103, or the total present value, 103.08. That gives me a proportion of 0.3539 times 1, okay, which is right here, as you can see. And so we get that 0.3539 times 1. That gives me that, all right? This is going to give me my time in terms of Macaulay duration, all right? Next one would be the 34.29, okay, times, or let's see, 33, excuse me. Let's make sure we got the right one here. What happened to the other one? Hold on one sec. 33.27, right? 33.27. So this would give us, if we took this, we would take that and take 0.3327 times 2, okay? Since 0.3327 is a proportion in the second year. So that's taking that 34.29, right, dividing by 103.08, gives me 0.3327 times 2. We'll double that. That gives me about 0.66.54. Remember that this, when you do the proportions, okay, they must add up to 1. And next, we're going to do the third year, which is when we look at that cash flow of 31.75, okay, times 3, all right? And why did I put that? Hold on one second. Oh, that's the proportion, never mind, sorry. 31.75 divided by 103.08 gives me 0.3080. And I take that proportion times 3, or 3 years, and that gives me 0.9241. Now we're translating it into time. And this would be the amount of time that it takes to recover the total present value of the bond. And this would be 1.9487 years. Okay? That's what they call the Macaulay Duration. And now with that, what we can do is we can move that and move that. And now to get the volatility, or the, as they say, the interest rate sensitivity of the bond price, what we can do is actually say, okay, well, let's divide it by 1 plus the yield to maturity, or discount rate. And this is years. This is 0.08, okay, which gives me about a factor of 1.8%, okay? So what does that mean? That means that when a bond price, when the interest rate moves by 1%, the bond price should adjust one way or another by 1.80%. So let's see if it's true, okay? And that is problem 13. Now, let me compare this duration with the security B and C before I go on and show you something else. So you guys, again, if we look at this particular problem, in this case, we've got the security B has a coupon of 20, 20, and 120, which could be 20 plus the principal. And security C has 10, 10, and 110. So what are the different durations compared to the $40 straight across paid out each year? And we did get a 1.9487 or 1.95 years in terms of recovering that present value, which is a fairly low duration. And when we look at it, let me pull out the solution here, if we can find it. Okay, and the solution for number 13 is, voila. And this is the way to usually set it up. I mean, obviously, you can use Excel or the other one. Looking at the $40, we see that the duration is much lower. Doesn't take that much time, okay, to recover our present value of the cash flow, which is 1.9487 years. Compared to when you've got big payments at the end, so you've got that 20, 20, and 120. And let me see if I can zoom in a little bit more here. And you've got the 10, 10, and 110, okay? So in this case, you've got lower coupons here, then you get a bigger payment right towards the end, okay? Notice that the duration keeps increasing, all right? So there's something to be said there. Now, in terms of volatility and price sensitivity for a 1% interest rate change or on the yield, going yield, market rate yield, how would our bond price change? It would change by 1.8% in either direction. Now, this one right here, 2.39% and 2.54%, okay? So just a heads up, that is number 13. And let me go through a brief example, and I will come back to that actually. But I do want to show you, when we're looking at that, and if you do work it out, you can see that this is the case. So I'm going to give you guys a little formula here that I think will be helpful. This won't take long. And by the way, do we all understand why when, let's say, how can I explain this? Let me give you a scenario. With interest rates, when they change, obviously that changes the bond price. Okay, so as interest rates go up, the bond price will go down, etc. So like, just imagine if you were to hold let's say a $40, you were holding a bond that paid $40 coupon, okay? You had 3 years left to maturity. Now, and that's a 4% coupon rate. Now, let's say if the rates change and on pretty much the same bond now is paying a 5%, don't you sit at somewhat of a disadvantage? You're receiving less interest than the going rate of interest or the going coupon on a newly issued bond. So that's kind of why the bond price adjusts down lower. So when that interest rate goes up, I hope that makes sense. We'll work through that a little more. You guys, I just want to touch on a little more on duration and changes in the bond price. Wanted to go through this problem real quick. And this is, I'd like us to go through this. I'm going to post this online real quick. You have a 10-year 8% coupon bond, and the current market rate of interest is 7.25%. The bond will have a duration of 7.325%. Excuse me, did I say percent? 7.32 years. If interest rates fall by 80 basis points or 0.80, what will happen to the bond price, okay? And again, let me show you, before I go here, let me show you in the book what they're talking about. And they usually deal with just a 1% change. In the book, they discuss, let's see if we can find it here. Okay, so notice that they actually work it out, and you can work it out, and that's what I'm going to go through. When we do have, and where did it go here? My problem. Okay, so we had a 1.948, okay, in terms of Macaulay duration, in terms of years or periods, okay, and that led to a 1.80% volatility or change. So that's the price sensitivity. So for a 1% change in interest rate, my bond price is going to change by 1.80. How does that work out? Well, look at it, right on page 54 in the book. You can see where they're taking duration over 1 plus the yield, which is this, the modified duration. So for a, as it says, the percentage change in the bond price, how does it change for a 1% change in the yield? Let's try the formula out, okay? And again, they're looking at different changes in the yield as they go up, as they go down. We're going to work one out. And this is actually a change of, it looks like they're going by changes of, anyway, we'll come back to that in a minute. So when we look at this, we're going to find out how much our bond changes by. In this case, they use 0.5%. So I wanted to give you the area where that's at so you can see that, just in case you want to work it out. Let's work one. All right. Let's work this one. So let's do this real quick. All right. Can you all see that? I hope. All right. What does this mean? This means, how is the bond price change in the bond price, the present value of the bond? Okay. And all this is, guess what this is? This one right here is Macaulay Duration. Okay, actually, this is Macaulay Duration right here in terms of time. So this is going to be something like years. Okay, and I believe in ours it was a little different. The bond will have a duration of 7.32 years. So this would be 7.32. What is our going yield to maturity or current market rate of interest? 7.25. So the yield to maturity would be 7.25 or 0.0725. Okay. And what it's saying here, and this is a really, I mean, think about it. You can predict how a bond price is going to change given a interest rate movement is pretty handy, especially for loans, etc. So you can actually work out changes in different components of a bond. So when I look at this, this is also in terms of the change in the interest rate. Okay, so when we read this, it says, how much does the bond price change? Well, here's the formula. Okay, there is a negative modified duration. Okay, that's duration, Macaulay duration in terms of years or time, 7.32. That is 1.0725. All right, 725. I'll post this. So you have a 10-year, 8% coupon bond. The current market rate is 7.25%. This bond will have a duration of 7.32 years, okay? This one, I already figured it out ahead of time using the same exact way we did it right there, okay? If the interest rate moves or falls by 0.80 basis points, wouldn't we expect the bond price to go, the change in the bond price, at least to be positive and to increase, right? So this is looking at the change in the bond price in terms of percent and also in terms of dollars, all right? And I'm giving you guys this formula because I don't think the book does a very good job of explaining it. What will happen to the bond price? So let's check it out. Let me see. So this is kind of tagging off number 13 in the homework. And also, again, might as well go through this explanation that I had before I do this. Well, let me hold on just one real quick sec, and I'll come back to that. So we can predict a percentage change for 1% change in interest rates. In this case, we're predicting for a 0.80 change in the interest rate, or 80 basis points, okay? 0.80. Now, in this case, what's going to happen to, in terms of the bond price, how will it change in percent terms? How will it change in dollar terms? Here's the formula. All right, so I rewrote everything. How is the bond price going to change? I took the bond. It is a 10-year bond, okay, annual, and it's paying 88% coupon. All right, now I'm going to pull out my calculator here in a second, and this will be on the test, okay? Just a heads up. We've got a $1,000 value at maturity, which will pay out, okay? And they're giving us about 8% interest. Again, remember that duration, or Macaulay duration, is the 7.32 years, okay? And I worked everything out. That is the yield to maturity. So this one altogether is the modified duration, or the volatility. This is a change in interest rate. This is, and remember, there's a big negative here, okay? And this will be the change in the bond price in terms of percent and also in terms of dollars, okay? And we can work that out. So, and again, I'm using this right here, all right? So when we do that, feel free to skip through this quickly if you want. I actually worked it out, Okay, and I've got, see if you can see that. I believe you can. Okay, we've got the duration. Okay, we've got 1 plus the yield to maturity. All right, which is 7.25 or 0.0725. So this gives me that modified duration, and I take a negative of that. All right, now it says here that the interest rates fall by 0.80%. So I would expect the bond price to go up. In this case, I've got a negative fall of interest rates, okay, or negative fall. Did I just say that? A fall in interest rates of 0.80, or this is 80 basis points. 80. Okay, that's the change. 8. So in this case, when I calculate this for the modified duration, modified, there's a negative out here. And when we take it all together, it's a negative times a negative. I get 6.8252 times 80 basis points, or 0.80, gives me a bond change in the positive, which means that the bond price will go up by 5.4 or 5.46%, or 5.4601%. Okay. So again, when they mean volatility, they're talking about price sensitivity of the bond. So if we do that, all right, this gives us about a 5.4601 or 5.46% positive increase in the bond price, okay, as the interest rate goes down, 5.80. Now, let's move on. So again, let me flip the page here real quick. So we can look at this and say, well, how much does that translate in terms of bond, the bond price in terms of dollars, right? And in this case, we're going to look at, given that 5.4601% change in the bond price, and that is an increase, we do need the original bond price to be able to figure it out, right? So let's go back to the problem. What were we given? We were given a 10-year, 8%, right? And let's see, the current YTM is 7.25%, okay? And it says we've got everything we need to calculate the original price of the bond at that point. So if this happens, just let's say the interest rate happened just right away, right after we purchase the bond. I'm going to say N equals 10, I over Y, or the interest, right, on an annual basis. The discount rate is 7.25. Present value, we don't know. Payment is 80, right? 8% of 1,000. 0.08 times 1,000. Okay. And future value, which is the value or amount at maturity, is 1,000. So when I work that out, I actually get, okay, can you guys see that? Hoping. I get a present value of the original price before the change of $1,052.07. Okay. And I did that on my calculator. Yes, ladies and gentlemen, I did. Where is my calculator? I'm working in tight quarters here today. Okay, so when we do that, now we had a positive expected or predicted change of 5.4601, right? And it was a positive one for the bond price since the interest rate fell by 80 basis points at 0.80. So what I would do is take that original bond price, okay, 1,052.07 times 1 plus 0.05461, okay, which gives me about 1109, okay, a bond selling for a premium. All right, so that would be the dollar increase, or the full amount that it changes to or increases to in the bond price. It was 1052.07. It changed to $1,109.52, 51 cents. Okay, due to a 0.80 percent change in the interest rate. And that's a fall. It actually fell. The interest rate fell. Okay. So how do we know if this prediction is accurate? And this is how we use duration. Well, one of the ways to check, all right, is just imagine overnight if that market interest rate moved on us and it fell or dropped by 0.80 or 80 basis points. Okay. Now, how would I calculate that? Again, going back to that same problem, I'm going to go to, and let's not pay attention to convexity here, but note the duration says the bond price will rise by 5.4%. Assuming the annual coupon payment, the bond was originally valued at 1,052.07. So duration, okay, predicts, and in this case, they're talking about modified duration, all right? Remember that we had Macaulay duration, which gives us years. Modified duration gives us the volatility or the expected change in percent terms. And so duration predicts a price movement and the price to increase due to that 0.80 drop in interest rate to the increase to 1,109.51. However, if we recalculate the bond price at new rate, all right? So in other words, what we're saying here, how accurate is this prediction, all right? And there's a point behind this that I'm trying to make. So I reworked it on my calculator, and it's still at 10 because it happened pretty much overnight. The only thing I'm going to change is I'm going to take the 7.25 original yield to maturity. Okay. Now imagine if the market rate or dropped by 0.80%. Okay. Not 1%, but just a little less. We will get a new going market rate of 6.45%. Okay. Present value, we don't know yet. Okay, I'm going to cross that. I wrote that in, but let's imagine we don't have that just yet. Okay. And the payment, coupon payment, is still 80, and the future value is 1,000. Okay. So in this case, what I'm going to do is I'm going to calculate that, and I actually end up with 1,000 using my calculator, $111.69. So I'm a few dollars off compared to the predicted change of 1,109.52 due to the 0.80 percent drop in interest rate. So in this case, I actually did work it out using the new changed yield to maturity due to that 0.80 drop. I got the new price of where it should be at, all right? So why the difference? Shouldn't it be this? This is what we predicted, but there is some error in there, all right? And let me show you where it comes from. And I remember that I calculated it went from 7.25, we knock 80 basis points or 0.80 off that, we get 6.45, all right? That's where this comes in right here, which gives us a price of 1,111.69. Okay, so what's the difference between these two? This is the predicted, okay? This is the actual, given the new YTM with a fall of 0.80 or drop of 0.80. Okay, so what happened? Let me show you. This is where I'm getting to. This is a big point in this chapter. All right. Again, as we look at this chapter right here, all right, This is them working out the duration and the volatility. All right, and that's worked out in your, it's actually table 3.4 worked out in your book or textbook. But let me show you something here real quick. This is what we call, as I said before, bond. When you have an interest rate change, the bond price doesn't change one for one. Okay, it isn't a perfect proportion or a perfect proportional change. In fact, if you look at the way the price moves with the different changes in interest rate, you actually have and the relationship between bond price and interest rate is actually nonlinear. It's convex, okay? What you have, though, is when you have, let's say, only a 1% change, then it's a pretty, the modified duration measure is a pretty good measure of change, because you can see that for a 1% change, all right, if we drew these points out here, right there, and then you have right there, and right there, you could say, oh, okay, well, if it changed by, let's say, it increased by 1%, okay? And if it originally was at 0, okay, which is about, what was that, 1350, right? And it increases to 1%, we know that if the interest rate increases or the yield increases, the bond price will fall, right? So it falls to actually below 1,300 when originally, okay, at 0% was earning just above about 1,350, maybe even I would say right under 1,400. So just to give you a heads up, when bonds have a shorter duration, they basically, when bonds do have a shorter duration, it tends to be actually, and you have a shorter term bond, duration is a more accurate predictor, okay? The farther you go out in terms of changes, the more difference in error you're going to have. So just a heads up on that. That's just to give you a little relationship. As we go into this, and I will post these exercises on the web, all right? As we go through this real quick, just a couple things to keep in mind. A zero coupon bond is just a bond that sells at a discount, okay? And it doesn't pay coupon interest per se. It's kind of implicit. It's thought of as, okay, it does actually, the coupon interest is woven into the price. So the duration of a zero coupon bond, and I will go through that in class, zero coupon class, write that down, is equal to, and that's the Macaulay duration, the time to maturity, okay? Everything, and this is the relationship of how duration works and how interest rate affects the bond price and vice versa. If you hold maturity constant, and some of these are pretty common sense, the higher your coupon rate, the lower will be your duration, which is a good thing. Actually, it means the bond is more valuable because you have higher, remember those 40, 40, and 40 versus 10, 10, and 110? The closer your high price coupons are, and the faster you realize that present value of the bond, the more valuable it's going to be. So anyway, just a heads up. And it says the more valuable it is due to early higher coupons. If you hold constant the coupon rate, as maturity goes out, the duration grows. Why? That's again due to interest rate risk, due to the movement, possible movement of interest rates. The longer you hold it, the more interest rate risk you're exposed to, among other things. And all else constant, duration of coupon bonds is higher when yield to maturity, okay, is what? Lower, okay? And that has to do with the modified duration calculation, which is just the Macaulay duration in terms of time divided by 1 plus yield to maturity, okay? Again, very good predictor of what a bond price will change to given a certain interest rate change. All right. You guys, we're going to talk a little bit about term structure. And we're going to talk a little bit about nominal versus real interest rates. But I want to go through real quickly and finish this off and the risks in the market. Let's go through what I see. Let's go through the rest of the problems. Let me just show you a couple of things here real quick. As you have a term structure, let me pull out the other, actually, let's go back to the homework and then I'll come back to this. Anyway, the point is think about when we look at, I'm going to pull up our PowerPoint here. When you have a term structure, you plot the yield versus the bond maturity in years. Everything from months right up here. These are short-term rates. Notice that they rise quite quickly if you have an increasing term structure. Okay, and that's usually a good outlook for the economy. Short-term rates are expected to rise when you have an increasing shaped curve, and these are what underlies these are spot interest rates. Okay, now this could very well be very similar to a Treasury yield curve. Okay, and if we look at this, we go out in terms of maturity. So we go everything from 6 months to 5 years, 1 year, 5 years, 30 years. Okay, and notice that the rate increases the farther you go out. Why? Interest rate risk, along with some of the other risks that are involved in the bond market, including credit risk or default risk, reinvestment risk, being able to reinvest at the same amount, liquidity risk, and so on and so forth. And I will go into those in a minute. But when we look at this, remember that the short-term rates are expected to increase, long-term rates are expected to decrease. Hold on one second. Let's see here. Let's go back and see if I've got something that covers this. Strip makes and strip is just a short-term bond, okay, where the coupons have been stripped away. In fact, it stands for, get it over here, separate trading of regular interest and principal of securities, okay? And that is very much similar to what you would see with a zero coupon bond, okay? The coupon bonds have been stripped away. We have the principal paying, all right? That might be a zero coupon bond. And then you have other coupon payments which actually turn into what we call strips, okay? So in this case, when we have this, and when we're looking at this, each strip makes a single payment of $1,000 at maturity. It says calculate the annually compounded spot interest rate for each year. Is the term structure upward, downward, or flat? And C, what would you expect the yield of a coupon maturing in December 2023 to be higher or lower than the yield on the 2020 strip? Okay, so let's go through that real quick. It's actually not hard. And then I will explain number 27, which can explain much more about it using the term structure theories. including the expectations hypothesis and also the liquidity hypothesis, among others. Just one sec. I want to forget to show you guys this. This is the different premiums or risks involved in the market besides interest rate and inflation risk. You've got default risk premium, which they add on or tack on in terms of the interest. Compensation for the possibility of default. That would be especially true of government bonds and other governments. Taxability premium, okay, on compensation for unfavorable tax status. Liquidity premium, compensation for lack of being able to sell, for example, a certain bond. Maybe there's not enough bonds for sale. Liquidity is a big problem in markets. Rollover risk. Can we roll the bond over at the same interest rate and refinance, etc.? Okay, and there are others. Can we reinvest at the same rate? Those types of things. All right, so let's go into this, and I'm going to show you how we set this up. So seeing that our main issue is right here, where we've got some strips with different maturities, okay? Beginning with Narnian Treasury Strips instead of U.S. government Treasury Strips. I like that. Each strip makes a single payment of $1,000, okay? So calculate the annually compounded spot interest rate for each year. Is that term structure upward or downward sloping or flat? All right, which is also an indicator of the economy. And would you expect the yield on a coupon bond maturing in 2023 to be higher or lower? I know I just repeated myself, but here's how we calculate it. So we got the price and percentage, all right? And this is typical of treasuries. Everything's presented, its price is presented in terms of percentage. All right, so let's go into it, and I'll show you how to do it. So first thing we're going to do is calculate the spot interest rate for each year. Second is we're going to draw that term structure, all right, and the curvature to it. And then we're going to look at what would you expect the yield on the bond maturing in 2023 to be higher or lower than the yield on the December 2020. So that's just going to tell you, is it upward or lower, upward or downward sloping, all right? So knowing that, that's number 26. I have a very simple formula. All right, and let's zoom out. And this would be, again, a very interesting scenario, okay? Again, we're looking at strictly the strips, okay, which are basically the coupons stripped away. Now, hold on one second. Here it is, where you can see the treasuries, where they actually have the U.S. Treasury strips. These U.S. Treasury strips act very much like NR, zero coupon bonds. And it says the U.S. Treasury or U.S. zero coupon strips allow investors to hold the interest and principal components, okay? Strips offer no interest, okay? The interest is implicit, all right, because they're zero coupon bonds. So they make up for it by having such a discounted price. And then, so just realize that these are very much, and you could tell because they were talking about the 1,000. Now, if we take a percentage of this, we can figure out the spot rate. If you look at the calculations here, what I like to do is take this formula where I have future value over present value, okay, to the 1 over n minus 1. So you can't get a spot rate unless you have at least 2 years worth of data. So what I'm going to do is take the 2-year spot rate, R2, all right? Then R3, R4, and R5. I don't know why I put R4 there, all right? And in this case, I'm going to calculate it, the spot rate for December 730, 9703. Okay, so this is the December 2020. All right, we're going to go out to December 2023. December 2023. This would be December, and that first one that were issued, remember that it was issued in December 2018, all right? So now we're 2 years later. December 2020, December, all right? So if you take the future value, okay, and don't use 1,000, all right, use 100. It just works better that way. In the meantime, I'll find the, I don't think they used the proper maturity value, but let's work it out. And I'll get back to you on that. $100, okay, divided by 90.703, which is the amount that is showing that it's priced out in December 2023. All right, and to get the spot rate, or basically the yield on this zero coupon bond, we would take that, take the future value divided by present value, 1 over 2 years minus 1. That gives us a spot rate in the second year of 2%, excuse me, of 5%. And for R3, we get 100 divided by the next given percentage of the price, okay? This allows us, again, this is convenience just to be able to figure out what the spot rate is, all right? Not necessarily to figure out what the price is. So if we've got a expected price of, in percent terms, of 88.892, and this is 3 years out, 1 over n, 1 over 3, future value 100 gives us a spot rate of 5.2. It's already looking like it. It's not humped. It's not declining. It's increasing in terms of the term structure. So we've got the yields, which is N right here. That's a yields, the time to maturity. So we've got 2023, 2020. They were issued in 2018. So we're increasing in maturity. And for the fourth year, we've got 100 divided by 81%, 81.49. And that's 1 over 4 minus 1 gives us 5.2%. And last one, the fifth year in December 2023, we've got 100 divided by 77.243 to the 1/5 power minus 1 gives us 5.3. If you put those out and plot those, okay, accordingly, you're going to get an upward sloping curve, which is also speaks positive of the economy, where you have short-term rates are expected to go up. And of course, the longer you go out into maturity, okay, the higher the yield or the spot rate will be. Spot rates are used to calculate yields to maturity, but it gets much more complicated. In fact, the yield to maturity is the average of spot rates. So when we look at the yield curve, okay, this would be R1, R2, R3, did I say that? R2, R3, R4, R5, okay, and so on, and you can draw it from there, all right? And what do we have on this y-axis here? We've got our yield, all right? So is it upward sloping, or, God, I can't speak today, or downward sloping? It is upward sloping, all right? Indicative of a healthy economy. Have we seen an inverted curve? Yes, we have, especially lately, okay? That's why folks used to or like to use the Treasury yield curve, all right? So in this case, spot rates are the closest thing you're going to come to the bare, or basically a great measure of interest rate, all right? Now let's go into the term structure. What causes the term structure to act like it does? There's a couple of theories behind that. One is the expectations theory. The other is liquidity theory. Number 27. Okay, and let me just read the problem real quick. Number 27 says the 1-year spot rate is R1 equals 5%. The 2-year rate is R2 equals 6%. If the expectations theory is correct, what is the expected 1-year interest rate in 1 year's time? Okay. So, and again, I would suggest, or highly suggest, that y'all go to the appendix that I'm uploading. All right, that's going to come in really handy. And it goes into graphing the term structure, goes into the expectations hypothesis, into defining the forward rate, all right, which is this. And that actually is what we're talking about right now. It will go into, just one second here, I know it's in there, the expectation hypothesis, all right, and the liquidity preference theory, or liquidity preference hypothesis. Let me just go into this. So it's basically saying that in number 27 that the spot rate in year 1 is 5%. The 2-year spot rate is 6%. Okay, how would we figure that out? Well, let's take a look at it. So let me show you how you can interpret this. One way, again, we've got the 5%, okay? Look at the 6% rate at the 2-year spot rate, the 1-year rate, all right? And basically what we're looking at is the gist of the expectations theory. So to be able to figure that out, I'm going to need to take the future value of $100. So that'd be 100 times 1.05 using the rate of 5%. Okay. You wouldn't even have to worry about this right now at this point. Just take 1.06, okay, which is 2-year rate at 6%. So you do that squared, all right, and divided by the 1-year rate, 1.05, and the difference in return is going to be your rate expected in year after year 1 in the following year, okay, and that is called 1R1, okay, or the 1-year rate 1 year from now. That is also known as the forward rate. It's expected to be 1.0701. Again, the formula for it is just, if you rearrange, okay, you would have 1.06 squared equals whatever the 1 plus 1R1, okay, and times 1 or plus 0.05, okay, that's going to give you, and that's how we get this, we solve for this, and that gives us our forward rate. Now, if we get a 1.07, take away the 1, and that gives you 7%. If we expect greater than 7% for the 1-year rate 1 year from now, what we would probably do is when our 1 year expires with the 5%, we would sell and reinvest at a higher rate, especially if we thought it was going to go over 7%. If we thought it's going to be the same, we would stick with this, all right? And that's basically the gist of, it's the rate that makes you indifferent between doing 1 In other words, sticking with the 1-year rate, reinvesting in another 1-year rate 1 year from now, or reinvesting in the 2-year rate, spot rate, excuse me. And so if you do that, that's called the expectations theory, all right? To whereas the liquidity preference theory says, you know what, if you're going to go out another year, you need to provide a higher rate or a higher yield. And that's just behind, that's a very, very simple just behind the liquidity preference. And to give you the exact, even though I know this, I still have to look back at it. So again, when we're looking at this forward rate for the expectations, it says the forward rate over the second year is set to the spot rate that people expect to prevail over the second year. This is called the expectations hypothesis. It states investors will set the rates such as the forward rate over the second year is equal to the 1-year spot rate expected over that second year. Now, liquidity preference, okay, is in order to induce investors to hold riskier 2-year bonds, the market sets that forward rate over the second year to be above the spot rate expected over the second year, or the 1-year rate 1 year from now. And that is the liquidity preference, okay? Again, this is in the, and there's other theories, but these are the two main ones that I expect you to know. The reason is it's extremely important to how interest rates work and to get a better understanding of what goes on behind the term structure and the yield curves. This is in the appendix. Ah!